So let's just think about the problem and the subject matter of today. Earthquakes, droughts, floods, storms, and so many other natural catastrophes impact over 500 million people every year. Over half of the world's population lives in regions highly exposed to extreme weather and natural disasters. Typhoon Haiyan in the Philippines and flooding in India were just two of more than 300 major disasters recorded, both man-made and natural, in the year of 2013. Swiss Re runs a database, and the figures I'm going to give you come from that database. The social cost of the events was extremely high in 2013. Almost 26,000 people lost their lives or went missing. And the economic cost of the disasters added up to about 140 billion US dollars. Now, for the insurance and the reinsurance industry, the financial burden was comparatively low, with insured losses of approximately 45 billion US dollars. So about 1/3 of the total economic losses were covered by insurance. And that statistic is consistent over the last 30 years. We call this gap between insured losses and economic losses a financial protection gap. And as these losses are not covered by insurance, where do they go? And of course, those losses fall upon the individual citizens, the businesses and corporations, but typically the vast majority of the losses is borne by governments and hits their budgets. Now, there's a long-term trend pointing to rising economic and insured losses due to the concentration of assets in exposed areas. And of course, the effect of climate change are very hard to predict. The financial impact on governments' budgets becomes even more acute because funding of these costs historically has typically been after the event. So an event occurs and the budget of the government has not planned necessarily for this event. What do? Well, sometimes they redirect existing budgets, and that could be harmful for health or education budgets. Sometimes they look to raise debt, and debt is not always as easy to raise in a moment of crisis as you would like, and of course takes time and has to be repaid. We have seen situations where governments have raised taxes on the individual citizens to fund the recovery costs, and we have seen governments selling state assets at a time of crisis, which is not always the best time to be doing so. So the disadvantage of such ex-post financing reactions is they take time, of course, to arrange. They could jeopardize investment plans and arrangements for other causes. Debt financing may not be possible or may only be available at high cost and could easily take 6 or 9 months to arrange. So in a nutshell, it's highly uncertain if and at what cost ex-post financing tools are available. We therefore see around the world a growing interest in ex-ante or pre-event financing instruments, such as reserve funds, contingent credit facilities, or risk transfer through insurance solutions. And let me stress, insurance solution is not the silver bullet to these challenges. It's a tool that should be in the box of the governments. It's a tool that should be used much more than it is already, but it doesn't negate the necessity to have other arrangements in place. So there are different approaches for governments to address the financial protection gap in their natural disaster management strategies, and we will hear of different approaches from our speakers as they share their experiences and lessons. So firstly, Mr. Halil, Head of Strategy Development of Turkey's Disaster and Emergency Protection, will speak with us. Of course, Turkey has high exposure to earthquakes, and a large event in recent history has led to fundamental changes in the natural disaster risk management and financial strategy. We're eager to learn more, and the floor is yours.
Thank you. Dear Chairman, Mr. Parker, distinguished guests, now it is my privilege to address you on behalf of AFAD, Turkish Disaster Management Agency, regarding our activities on disaster risk management, reduction activities. Of course, thanks to Mr. Parker, he gave actually in his speech, introductory speech, the broad range of information about the DRR, then especially financial tools. Of course, I will try to concentrate on Turkey's experiences. As you may know, Turkey is one of the most complex regions in the world, I'm afraid. It is prone to natural hazards such as earthquakes, floods, landslides, and avalanches due to its geology and its topography and its climate. And due to its geopolitical locations, Turkey is also affected by conflicts and large-scale humanitarian crises happening just outside our boundaries. Just to mention, now we host more than 1 million Syrian refugees in our capacity. And of course, while I will touch upon the financial needs to improve humanitarian response in every aspect, I will mainly focus on the economic side. And specifically, as Mr. Parker mentioned, the earthquakes, as they account more than 8% of the homes destroyed in my country previously. And Turkey is one of only 13 countries that grew from middle income to high income country since 1960s. And this robust growth was coupled with a transformative urbanization process, and which is still ongoing. And it was 1950s, just 4% of population lived in cities. But today, it is more than 8%. And 2/3 of the country and again more than 70% of the total population lie in first and second degree earthquake zones. Maybe that is the main reason why we must, as Turkey, be on alert both technically and financially for potential disasters. Distinguished guests, now looking at the financing of the disasters, potential disasters, and identification of the risks, as you all know, middle-income countries have a growing interest in sovereign disaster risk financing and insurance to help them to better financially prepare when disasters strike. And most middle-income countries still rely heavily on post-disaster financing through budget reallocation and post-disaster borrowing and also tax increases, as Mr. Parker mentioned in his speech. And we, Turkey, since the establishment of our republic, it was 1923, successive Turkish governments relied mainly on ex-post financial resources rather than ex-ante funds. And now we shifted radically our approach, especially following the 1999 Marmara earthquake. Did you know the Marmara name of the region? Just very near to Istanbul. So Marmara earthquake, we call it. And after that, we introduced our first disaster risk financing and insurance tool. The name is, we call in short, the compulsory earthquake insurance scheme. And with a majority of population living in these earthquake-prone areas, the persistent potential for large-scale natural disasters has become a fiscal and social issue for the Turkish government. And earthquake insurance uptake was relatively low in Turkey previously it was just 3% of the residential buildings. As households traditionally relied on the government to finance the reconstruction of private property and after major natural disasters. But this presented massive challenge to government budget, of course. And this issue led to establishment of the Turkish Catastrophe Insurance Pool in 1999. In my speech following, I will just use the term insurance pool to make it easy to understand. And aside from fiscal exposure, the main rationale for the creation of this insurance pool was a very low level of the catastrophe insurance penetration among households. And this is modeled on the California Earthquake Authority and the New Zealand Earthquake Commission, but of course adapted to local realities. This insurance pool is a public sector insurance entity and providing catastrophe risk insurance for the Turkish homeowners. And this is genuine public-private partnership. And this pool has no public employees. All of its business functions, from sales to reinsurance to claim management, are subcontracted to the private insurance industry. Just let me give the main objectives of this insurance pool, a couple of points. The first is to ensure that all property tax-paying dwellings have affordable earthquake insurance cover, and to reduce citizens' dependence on the government fund to reconstruction of their property. And again, third one is to reduce government's fiscal exposure to earthquakes by transferring excess catastrophe risk to the international reinsurance markets. And lastly, to encourage physical risk mitigation and safer construction practices in Turkey. And this pool, ladies and gentlemen, is a legal public entity, as I mentioned, and that provides compulsory property earthquakes insurance for those owners of the private dwellings. And also, those dwellings built legally on registered land. And premium rates are actuarially sound and not subsidized by the government. And it varies with construction type and also property location. And it also covers the risk include the fire as well as the earthquake. Ladies and gentlemen, with this insurance pool, of course, there are some lessons we learned. Let me share you with some figures. The number of earthquake policies sold increased 10 times from 600,000 in 1999 to today. It is 6.5 million household owners insured by potential disasters. And again, this insurance pool provides insurance coverage to 23% of dwellings countrywide and about 40% in particularly disaster-prone areas. And it became mandatory for new water electricity connections and also ownership transfers recently. Dear colleagues, as a second, having informed you about our compulsory insurance scheme, now let me share you with our second disaster risk financing strategy, which is a project conducted together with the World Bank and Turkish authorities. It is the Istanbul Seismic Mitigation and Emergency Preparedness Project. And it focuses on strengthening critical infrastructure throughout the city. To date, more than 1,000 public buildings were reconstructed or retrofitted. in Istanbul, including schools that serve more than 1 million students, teachers, and also together with schools, hospitals, and clinics that serve about 8 million patients annually. And a major economic center, as you know, Istanbul is Turkey's major economic center and home to 15 million people. So they are all vulnerable to earthquakes that can have devastating consequences on the economy as well as human lives. And there is even more to do to expand this program to the other cities in the future. And coming back to climate change, in Turkey, progress has already made on climate change adaptation. And climate change is an increasing concern for businesses in Turkey, of course, as well as worldwide, where water scarcity is a growing challenge. But I don't want to go into details, given time strain this climate change, but come back if necessary. To summarize this disaster risk reduction issue, Turkey has embraced a more systematic disaster risk management approach that is better adapted to its unique risk profile and aligned with its economic growth and urbanization strategy. And in 2009, with the establishment of the AFAD, Turkish Disaster Management Agency, we brought together various agencies under one roof. And AFAD embodies this radical shift in government strategy from disaster management to disaster risk management. So, establishment of AFAD itself actually just the very important step for us for the DRR system. Just let me share with you a couple of strategies AFAD put on effect. Now we have first the strategic plan for the disaster management for the started in last year and following 4 years. And again, just to mention names, we have National Earthquake Strategy and Action Plan for the next 10 years. And we have National Climate Change Strategy the following 5 years. And also, recently we are working on Turkish Disaster Response Plan. And we are working also on an overarching policy document to provide a broader national disaster risk reduction strategy. And more than 1,000 projects now are in progress. Ladies and gentlemen, Turkey has also taken significant steps in the field with the establishment of the Turkish Disasters Data Bank. With this data bank demonstrates Turkey's disaster vulnerability. Based on this, we shall develop a robust strategy for risks that may occur in the future by taking historical risks into consideration. Having said that, now I just want to share with you, before I conclude, some international engagements in DRR activities. Now, regarding to preparation to DRR for global platform in Sendai, Turkey is the chair of the European Forum of the UNISDR for the DRR Working Group on Governance and Accountability. And we aim to contribute to the post-2015 process in the short term by analyzing the DRR governance and the DRR governance and the accountability report for the HF process. And another specific contribution would be, we would like to share in Sendai with a project called Celebrating HFA Achievements on School Safety. So we focus on school safety, again with the UNISDR joint project. And one of the main outcomes of this project will be the capacity increase in building school resilience to disasters for Southeastern European countries. And we will hold the kickoff meeting of the project in September this year in Istanbul with the participation of ministers of 15 related countries that are leaders in the region in the field of the school safety. And dear colleague, in conclusion, Mr. Parker, I would like to reiterate our commitment to continue to cooperate with all partners at all levels. We also attach utmost importance to the outcomes of the Sendai conference, as they will definitely impact upon the World Humanitarian Summit to be held in Istanbul next year. And we also believe that Turkey is on the right track by pursuing new, innovative disaster risk financing and insurance strategies, as they represent a sound guarantee of sustainable economic growth and resilient urbanization. And we are in for the long haul on this and look forward to working together. And of course, before I conclude, there is a huge, the financial protection gap, as Mr. Parker mentioned, is also still huge in Turkey. Thank you very much.
Thank you very much. It's a fascinating journey, catalyzed by a major event, of course, but it's unfinished business. As you hear, there's a lot more to be done in the future. And I think that's something for us to reflect on during the question and answer session. Turkey is taking a very generous attitude also in sharing its experiences very often. So we welcome that opportunity to learn from Turkey's experiences as well. Our next speaker is Dr. Heinz VOLLENWEIDER, CEO of Europe Re. He's going to share us the management perspective of setting up a new carrier looking to help governments and domestic homeowners. In his previous role as Chief Underwriting Officer of Partner Re, he was also instrumental in the Turkish homeowners catastrophe insurance pool that we've just heard a little bit about. So in a sense, it's a small world. Heinz was also a former Swiss Re colleague, so it's a great pleasure to introduce you, Heinz. Thank you.
Thank you. Ladies and gentlemen, I feel happy and excited about this opportunity to address you and to explain to you who is Europa Reinsurance Facility Limited, what is its core mission, and how is it planning to implement it in reality. What benefits of its operations should citizens of our member countries expect, including the domestic businesses, the farmers, and of course the country as a whole? Well, let me start at the beginning of our involvement in what originally had been a project launched by the World Bank. They found that whilst natural disasters unfortunately are a reality in Southeastern Europe as well, market penetration of insurance covers against earthquakes, flood, and other adverse natural events was below 5%, so a similar situation to the Turkish, as we have heard before, in most countries of the region. This presents a huge exposure to the budgets of the local governments, who, in case of such an event, are expected to come to rescue and mitigate the financial consequences of large numbers of houses damaged or even destroyed completely. The idea was born to cooperate with the private sector, the insurance industry, to find an adequate solution to the problem. Having most properties of the citizens, the small and medium-sized enterprises, insured by the private insurance industry would offer an enormous relief for the government's budgets, and the freed up money could be used to invest in objects like hospitals, schools, roads, and other things that would also benefit their citizens. With this thought in mind, Europa had been established a couple of years ago and had been considered the implementation agency for this project. The aim was to establish a scheme in which the private sector insurance companies would become motivated to grant insurance protection to the citizens, the small and medium-sized business sector, and the farmers with adequate insurance cover. Analyzing the prevailing situation in the member countries made it very clear that this insurance cover needed to be two things at the same time: sustainable. The existing covers in place probably did not have this criteria, and affordable at the same time. And you can see that as a sort of contradiction. Sustainability means sufficient premium volume to cope with the losses to expect. Affordability, the lowest possible premium, not exactly a win-win situation. For sustainability, we hired the services of one of the three best-known risk modeling companies in the world to develop for us the risk models and pricing tools, which has been a first in the region. Nothing existed before. When you do something good, the supervising authorities are your friends, right? When you want to fight off irresponsive competition and defend sound underwriting principles based on thorough risk analysis, the supervisory authorities can even become your allies. They help you. We had many educational meetings with them discussing the principle of a sound risk-based solvency calculation, not the simple percentage, not the simple percentage of the premium as is customary in other countries. They really analyzed the risk situation to determine the necessary risk capital the insurance company should have. So they now do this similar to the very rigid Swiss solvency test called SST. Europa Re is also measured against, being a licensed Swiss reinsurer by now. The second aspect, affordability, however, cannot be found by breaching these sound risk considerations and offer insurance cover at a discount. The area to analyze here is transaction cost. Given the relatively small premium per insured, an efficient underwriting and administration system was of the essence. Consequently, we had an experienced IT company developing a web-based underwriting platform where agents of the interested insurance companies can relatively easily enter all necessary details about people, businesses, and farmers seeking insurance cover. All pricing work, accumulation control, collection of information to satisfy the reinsurance markets, and most back-office operations are now happening at a highly automated level, keeping transaction costs low. As a matter of fact, at one point in time, we even negotiated with Turkey whether or not we could buy their platform, but for I don't know what reasons, the negotiations failed, so we had to build our own. Europa Re is now a unique and above all functioning model of cooperation among states in the region, global institutions, and the private sector. We function as a modern company that operates under the most stringent Swiss standards in the insurance business. Our founders and main shareholders are the governments of the Republic of Serbia, the Republic of Macedonia, and the Republic of Albania, while our supporters, as already briefly mentioned before, are the World Bank, the European Union, the United Nations, the Swiss State Secretariat for Economic Affairs, in brief, SECO, and the Global Environment Facility, in brief, GEF, which is another organization in the network of the World Bank. We are very happy to have significant donor funds besides the capital input from the governments, because otherwise we would already have depleted our share capital, which of course in the operational phase should serve as risk capital. The first product that is now being officially launched is an insurance policy against earthquake. This product provides affordable, long-term financial stability and guarantee for the property of citizens of small and medium-sized enterprises in the region. Very soon, we expect the introduction of a similar product designed by us and covering risks from flood. It will most probably be sold in combination with the earthquake cover. And then also of another unique insurance product tailored for the agricultural sector that will provide farmers with a financial protection against the potential loss of their yield caused by any kind of adverse weather event. It is not actually a cover that in insurance terms would be called all risk, so the farmer can do what he wants and he will always be reimbursed. It travels by the name of area yield insurance cover, which means that the farmer is only reimbursed if the whole region suffers a reduction in outcome. So it's a sort of parametric cover. For extra security, every policy issued by our accredited insurance companies in the market in the 3 member countries can be reinsured by Europa Re. It is not obligatory. Some of the insurance companies already have their own reinsurance channels, but can be reinsured with Europa Re, for which we have adequate capacity in the form of our own risk capital, provided by the respective governments I mentioned before, and the confirmed support from the world retrocession market, led by a company who you have come across before, led by Swiss Re. Whilst we are happy and also a bit proud of our achievements, there is one big question mark remaining. All is not won yet. Here lies the difference to some other examples of sovereign financing of disaster relief like the ARC. We have an additional party involved, the public, the insured, the potentially insured. There is a similarity to the Turkish concept, as we have heard before, the difference being that in Turkey, the cover is mandatory or compulsory, whereas we try to introduce a private scheme where the insureds have the freedom to decide for or against insurance cover. So the difference to the other examples lies in the fact that not only do we have to motivate the local insurance companies to sell the products we designed, on top of that, we also need to convince the citizens, the small and medium-sized enterprises and the farmers to buy these products. Only if we succeed here will the premium money be available to finance the risks. This offers an additional challenge, as this might be more difficult to achieve than motivating the public to pay the taxes needed for a sovereign financing scheme. I don't remember why I put motivated in quotation marks, but I think it's appropriate when we say motivate to pay the tax, because sovereign funds in the end also come from the people through tax. The difference between the two systems is that if sovereign funds are used, all the citizens pay by their tax obligations, whereas in a private insurance scheme, all the insureds pay according to the exposure they represent. So only in the second system, only those who have a house or a unit at risk pay. So the proof of the cake is in eating it. Will the citizens, the small and medium-sized enterprises and the farmers eat our cakes? Will they take up our offer for affordable and sustainable financial stability, backed by our risk capital and the capacity of the international professional reinsurance market? Well, this remains to be seen. We shall trigger our marketing and advertising campaign that is also financed by donations somewhere in September. So with this, I would like to thank you very much for your attention, and also thank you for any possible future contribution to the success of this meaningful project. Thank you very much.
Heinz, thank you very much. I think Europa is very ambitious. It's something that's depended on a lot of collaboration, and that may be one of the question areas, I think. How do we get through that collaboration to make some of these things work? So our next speaker is Dr. Richard Wilcox. Around the world, in the Caribbean, a number of governments have come together under the Caribbean Risk Facility to create an insurance collaboration, if you will. In the Pacific Islands have made a similar collaboration. This is the first in Africa, the third in the world, and it's the first to take on drought. So Richard, we're delighted to hear from you on how things are going so far and what we should expect next.
And I'll actually be using slides in this presentation, so while that's being set up, I just wanted to take the opportunity to thank Martyn and Walter especially for having us back in Davos. This is actually my second time in Davos this year, and I'd never been until this January. And I think secretly many of you had a misconception about where Davos actually is. Because of its association with the World Economic Forum and the images of high flyers giving interviews out in the snow as profound as the snow is deep, I thought that Davos was on the outskirts of Geneva, and you would just take a cable car up from the WEF to the facility. What turns out is at the exact opposite end of the country, nowhere near Geneva. But with that clarified, I know that because the great introduction that we got from Minister Mangara of Senegal, you have a very clear conception of what the ARC is. We're a sovereign risk pool of African countries, and I don't think I need to go into the operations of the ARC, and things have worked exceedingly well, if I can say so, by dint of weather. We actually, in our very first year of operations, we had first policies go out in May. We've had our first payouts that are now coming to our member states, conceivably more than one, well ahead of the end of the season. And while that's, of course, bad news for the country affected, it's good news in the sense that the countries have taken out insurance policies for the first time, and we get to test the entire system, start to finish, from payout to contingency plan to operational assistance to benefits to the vulnerable populations that we mean to protect in the very first year. So we consider that as a reinforcement of our mandate from up high. That is, gets to trigger in the very first instance. But since our initial stab of creating the insurance company, I will explain briefly a bit more on the technical side of what this insurance company is and how it works, and then go into very briefly two new frontiers that we're reaching towards. One will be discussed in greater detail tomorrow, and the one that I'll discuss in greater detail today. So just on a technical sense, the African Risk Capacity is a specialized agency that provides services to its African member states to provide contingency planning in order to make the use of an insurance vehicle effective within the country. If you get an early payout, but you don't have the ability to credibly deploy those funds to the populations affected, the value of the exercise is severely undermined. So in order to get value out of the insurance proposition, the ARC created a system of a capacity building in countries, a peer review process amongst African ministers of evaluating each other's contingency plans through the ARC agency board, that then allows countries to participate in the insurance company. So only if you have been approved by your peers as having contingency plans to effectively use the funds can you become a member of the mutual insurance company, ARC Limited, which is a regulated insurer operating out of Bermuda. It is an entirely financially separate structure from the ARC agency. Our role in the ARC Limited was to cause the establishment. Because we're an international organization with privileged immunities as an intergovernmental body, we do not run the ARC Limited. It's an entirely separate structure with its own board. We cooperate closely because the only real link is we hold the keys to who can become a member of ARC Limited. Now, in addition to the ARC Limited, which is up and running since the beginning of this year, we've taken it further, and this is where we see a strong link to the upcoming post-Hyogo framework, and this is an effort that we call the Sovereign Disaster Finance Ratings. My colleague Ekoswehi Ian will speak more about that tomorrow, but just let me provide you some background. In order to access the pool, as I just said, we build capacity in the countries, then lead a process by which their capacities are evaluated and assessed, and only with that approval can you join the company. We have in that context come across some issues on, well, since you're the ones that help the countries develop their contingency plan, you support their capacity, then you always also lead the approval process. Doesn't it all sort of come back to one group and it's kind of a self-serving circle? We say, well, perhaps that is in fact true, and maybe there's a better way of doing it. We started up, somebody had to do it, we led the way. Well, we would see, in effect, a very useful function at the international level, and it perhaps goes beyond the ARC, and very keen to hear from you in the course of the discussion what you think about this, is to have a sovereign disaster finance rating scheme similar to what exists for sovereign debt. And effectively, a sovereign disaster finance rating scheme, as we will discuss with you in greater detail tomorrow, would look at the amount of reserves that a country has against the quantified risk, and for Africa, drought, and now soon flood and cyclone coming next year, we can show what those quantified risks are, assess the various reserves held against it to establish some sort of meaningful relationship between the two, assess the country's ability and willingness to finance those reserves, including the payment of premiums should they include insurance-type vehicles, and also assess the country's operational ability to use those funds effectively and accountably in the event of a disaster. Very similar to the work that our technical review committee did for approving countries' participation in ARC Limited. This could be based ideally on international standards that would come out of ideally the Sendai conference even. And if you're engaged on that front, we have some text that we would love to share with you. And we've discussed it also with our colleagues in the ICR, of course, who are leading this effort and who have been involved with us from day one. I see Pedro here, who was with us in 2010 when we actually named the ARC for the first time. So we've come a long way together, and I think there's something here that will allow us to do our work more effectively, but also will allow to crowd in the private sector. When you look at a country and you see its ratings on these three critical dimensions, it will help assess your business risk, your reputational risk relating to operational capacity. You don't want to make it pay out to a country and then see it not actually have an impact on the population and be questioned on that. It'll help countries compare each other's level of risk averseness, risk taking when it comes to providing for its populations, which would be an interesting aspect of governance, obviously. And it's an interesting tool for development partners to also look at their engagement with countries and what is to be done. Now, with the button being over here, I can move on to the second frontier that I will discuss perhaps in a bit greater detail today. This is the arc as it exists today, and we hope to have 20 countries for floods, droughts, and cyclones insured by 2019, hopefully a bit earlier than that. We've just started work on an interesting flood modeling, and we do all of our modeling in-house because it's so specific for the African context, and we're working on a microwave flood model now. We've given up on hydrological approach in Africa for reasons of data availability and complexity. We're trying a new model now. The cyclone work for primarily the Indian Ocean states is an off-the-shelf product that we're using. But now, the context of what I want to talk about the Extreme Climate Facility is that there's a discussion about climate change adaptation, and we face this a lot. It's one of the sort of throwaway questions you get. Well, it's a great thing that you're helping countries manage their weather risk, but isn't climate change coming and it's going to throw everything into question and you're sort of on some fool's errand out there? And there's amounts that are being thrown about for climate change adaptation in various public and negotiation forums that are just quite enormous. And you look at the budgets of development assistance and say, where is that going to come from? That is either there's a fictional debate going on here, or something needs to be done to bring this closer to a reality. And so what we've been thinking about is to build a facility that is data-driven, that really shows where climate change adaptation is needed most, and that allows us to pull in also private sector funding to be used in this process of financing these very large possible adaptation costs. And I say possible adaptation costs. I'll get back to in a minute. The African Ministers of Finance mandated us to come up with a solution for this in March. And fortunately, we already had a discussion with our colleagues, Esther and David Bresch at Swiss Re in Davos here in January, which gave us some ideas, and we've been playing around with this ever since. And we think we may have a formula forward on this. And essentially, it is a vehicle that would be a series of cat bonds, and I'll explain that in a bit. That's based on an extreme climate index for African countries, very similar to the extreme climate index that the United States has, but adapted to the local circumstances. And our technical team is working on that, and we believe we have I need to hedge this, a emerging plausible prototype that we can use for our African client countries to provide a financing vehicle over and above the weather risk that these countries are now managing systematically and responsibly through their participation in the African risk capacity, to help them mobilize adaptation funding should the data-driven the model show that the climate is in fact shifting with regards to extreme events in a observable and evident way. Now, the role of the private sector in funding development at large is always, it can be somewhat of a confusing debate. On one hand, there's the philanthropy. Private philanthropy, which is a very different story from the engagement of the for-profit private sector in development, which either has to relate to some capturable profits, at least in the midterm, or to some other opportunities where the use of private capital is in fact effective. Now, when it comes to climate change adaptation, we believe that is in fact a significant role to play for the private sector, for the for-profit private sector in this context, in the same way that we engage with the for-profit private sector through the reinsurance that ARC Limited has taken out on behalf of our member states in a very cost-effective way. When you look at the recent climate in Africa, and not going to questions of attribution and very sophisticated climate modeling that's out there, it's not all it's becoming worse and worse. That is just not correct. Look at West Africa, the slide over here. Since the 60s and 70s were horrible in West Africa, there's a big drop there. But since then, there's actually been a steady upward trend in rainfall, and cumulative rainfall is not good enough for any underwriting purpose, but we use gridded rainfall sets and whatnot for our own policies. But just to give you a sense, to say that it's just become drier and more extreme is just not correct. And the other regions of Africa, it's at best steady or unclear. When we look at the modeling available, what impact it will have, and we play a significant role in this through the European Community's Impact to Sea modeling exercise. That is the efforts of the European Community funded by the European Commission to model the impact on Africa through of an increase in global temperatures of 2 degrees. The adaptation model is one of the adaptation models used is our Africa risk view. We just pump in the model data through our platform, which we have for all of sub-Saharan Africa. And the results we get are frankly all over the map. From what we've seen, it cannot be said with any great degree of confidence that there will be such a great increase in more extreme events, but there could be. And climate change, certainly the temperature rise seems to be clear. It's the link between the temperatures and the frequency and impact of severe events that is less clear. And that's where the role of the private sector comes in, which is if you assume that you don't actually know for sure that climate change, the impact, and I'm only talking of the severe event spectrum, right? The impact of severe events, which is what we do in the disaster business. If you're not sure, then it makes sense that you might be willing to pay a group of investors for taking on the risk of making very significant payouts should, in fact, with greater statistical significance evidence emerge that there is a change in the climate that needs to be adapted to, but rely on that funding coming from the private sector rather than trying to rely on public finance right up front to create very large amounts, as are being discussed, for adaptation that may or may not quite be needed in that region at that time, and may or may not be the the most cost-effective way of financing these adaptation costs. Now, in the end, the way things work is we'll only know whether the climate has really changed in any reliable way 30 years from now when we look back and have a 30-year data set, which is the basis of climatology, and can really say that the severe events frequency has in fact changed over this period. Now, to go to countries and say, well, we will talk to you in 30 years, again, about this financial vehicle that we have for you and that might pay out at that point, is not a terribly interesting proposition. So you need to have something that, while acknowledging that it is really only at the end of 30 years that you can make a more definitive statement, builds around significant periods of time that can be observed and that are also that relate in a reasonable way to the budget cycles and financing needs of the countries, and also of the experience of the population in these countries regarding to climate change. So here's this index that we would track over time. And the financial design essentially would be an overlapping series of, non-overlapping series of 5-year periods, which would be the issuance series for cat bonds that would trigger at maturity. Should a predefined trigger, you can have these slides afterwards if anybody wants to look at them. It's probably kind of hard to see from here. Should a trigger be crossed at the end on the extreme event index, that would indicate with increasing confidence as you have additional 5-year intervals that the frequency of events has in fact changed. An adaptation payout would be made to those countries in increasing value towards as you move forward in the 5-year increments, and you gain greater confidence that the data you observe actually is meaningful. If towards the end of the series you see a shift to with great confidence to a new level, at that point larger public funding would also be required to underpin the adaptation efforts given the sheer size of the numbers. But with the XCF, we have a vehicle that begins to structure countries' engagement in adaptation finance that is data-driven, that is based on real observations, that also capture the experience of the country going forward. And in working in I'm down to my last 20 seconds, so I'll summarize this quite quickly. Working in 5-year increments is just long enough that the cat bond investors that we've spoken to will be interested in taking on this risk. And risk financing right now is as cheap as it probably ever will be. And it's just long enough that the ministers of finance would be interested in taking on these kind of functions. This would be a provision that the development partners finance in addition to the premiums, of course, that the countries finance themselves. It's a separate financial vehicle, and it could be the basis of an international mechanism for climate change adaptation that has been discussed elsewhere. And while it can be used in context to attribution, in the context of climate change adaptation, it's also a vehicle that stands on its own outside of the climate change loss and damage negotiation process that is quite complex. It stands on its own, that can be voluntarily funded moving forward. But it would be paid by the development partners in order to reinforce and protect those countries that have taken on the responsibility of managing their own weather risk through the ARC. we have 3 pillars. The first is the work is underway of working to evaluate in a similar process as it was the African Risk Capacity Agency, planning standards for climate adaptation in the countries, and we work with the Climate Development Knowledge Network out of South Africa that is working on development of these standards. The index design, as I discussed, is moving forward, and we are having a financial structure in place that most of you will recognize as a fairly straightforward 5-year series of cat bond issuances. This is a first preview of this new venture that we are putting forward, and at the Climate Summit in New York on the 23rd, my chair of my board, Minister Ngozi Konjo-Iweala of Nigeria, will introduce it to the global audience. So we're very happy to get your feedback, and we then look forward to the discussion on it. Thank you very much.
Richard, thank you very much. Gentlemen, you've given us a great deal of food for thought, and we'll move to question and answer discussion. The audience have been very patient with us. You've got a chance to ask a couple of questions through to about 12:30. I'm just going to ask the colleagues one question, and then we'll come directly to the audience. So when you have your question, please tell us who you are, who you're with, in terms of your affiliation, and then address your question. So the thing that I find fascinating, both in our own work in Swiss Re in public-private partnerships, but also in your work in public-private partnerships, is the amount of collaboration that's required one way or another. So the question I would like you to address is, what is your experience of that collaboration? And for those who will face that themselves in the future, have you any 1 or 2 guidance points on how to get successful as quickly as possible? Heinz, maybe we could start with you.
Well, I said before that we are a functioning example of private-public partnership, but of course this is not entirely true. Besides all the enthusiasm in this cooperation, I think we should not forget that there are also difficulties, because the cultures between private sector and public sector are enormous. And just neglecting or ignoring those will lead to failure. I think it is absolutely important that these differences are addressed. We have 2 different ways of doing the same thing. Sometimes I think that the public sector is moving much more slowly, but don't get me wrong, they do not work less than the private sector, but their work tools are sometimes a bit more complex. This needs to be addressed and discussed, and only then can the cooperation succeed. That's my warning. Don't be overly enthusiastic, address the difficulties and find solutions, and then it works.
Heinz, thank you very much. Richard?
That very issue of sort of the public aspect and the private aspect of our work was the reason for a long struggle in the design of the African risk capacity, where we have an intergovernmental function. That is, something needs to tell countries what standards are good enough for your participation in this pool. What are the standards for effectively and accountably using funds? That can't be a private company. That's not acceptable to a government to just have a private company say, well, we won't do business with you because we don't like what you do with the funds at this exercise. Yet at the same time, it is necessary. On the other hand of the spectrum, if you're paying your premiums to a company and you're putting capital into a company, you'd want it to be regulated by a respected regulatory authority and not just subject to sort of international rules that Richard Wilcox and his friends made up one evening and just think this is just good enough. So we had to find a balance between public governance and oversight and the regulatory aspect that you only get as a private company. And hence we have this split design that some people find quite confusing, of having an international organization that then causes the establishment of a insurance company, a regulated insurance company in Bermuda with its own board that is entirely separate from the agency, that meets the standard regulatory requirements for capital and whatnot, as most insurers in Bermuda do. To bring those two worlds together. And the private company very easily interacts with the international risk markets, just like any other insurance company from Bermuda would. Whereas the agency, with its governance that consists of public officials, doesn't have to deal with that aspect. So it facilitates the interaction at that level quite effectively.
Richard, thank you. I think we've just been advised if we could lean a little closer to our mics and speak a little louder, it'd be helpful for our audience. So far we're hearing that it takes recognition of the different ways in which we work. It sounds as if we should speak to those issues at the beginning of our relationships to find a way forward. I think in Turkey, we've also seen collaboration being very necessary. So, Halil?
Yes, thank you, Mr. Parker. Actually, listening to my colleague, of course, the bringing together the private and public entities for this insurance sector, for the finance potential disaster wasn't easy. But for our case, somehow we managed to put them together. So but our chance is from the public side, making the insurance compulsory was our turning point. Because as I mentioned during my presentation, it was when we first established the scheme, this insurance, earthquake insurance scheme, we just reached 600,000 dwellings out of millions of them. But 4 years ago back, when we make it compulsory, so the figure has been reached roughly up to 5 million dwellings. There's a huge difference. So we couldn't do this without this making compulsory. But of course, again, for the management of the systems also for future is important. Although it is totally owned and managed by private entity or just public-private partnership entity, there is still, we have the authority called Natural Disaster Insurance Authority, affiliated to somehow the government. So this authority, a kind of watchdog, watches the development. And if something goes wrong, they just enter into business, but not financially, at least to make sure the operation goes smoothly. So that is the case. Thank you.
Thank you very much. And Minister, last but not least, I think Senegal, as ARC was developing, hosted a series of meetings where you were trying to bring people to their conclusions. What was your experience here?
Je vous remercie, Monsieur le Président de séance. Disons à la question, nous pouvons avoir une double réponse. Dans une approche générale, on pourrait dire que déjà le mécanisme mis en place avec l'ARC est un bon exemple d'une expérience partenariat public-privé en matière de collaboration. Dans une démarche spécifique au plan interne, le Sénégal est en train de développer une expérience par l'institution d'une caisse nationale d'assurance agricole, qui est un véritable partenariat public-privé, où le Sénégal a une participation à hauteur de moins de 30%, et le reste est laissé au privé. Voilà à peu près pour répondre à votre question par rapport à une expérience de partenariat public-privé en matière d'assurance ou de réassurance. Je vous remercie.
Thank you very much. Now we have microphones for audience questions. Where are ladies and gentlemen with the microphone? We have one here. So questions, please, from the audience. We have one down here in the front, gentleman in the white shirt.
Thank you.
Hello.
Yeah, hello, thank you very much. Pedro Basabe from the UNICR, by the way. Thank you very much for the substantive insights and exposition that you made. On this issue of, I'm from the UNISDR. On this issue of private-public partnership, I think is key, not only for these financial aspects, but also for any of the aspects of disaster risk management, as you know. And that is why also the UNISDR is supporting any type of this collaboration, and it has a specific advisory group on it. And several sessions, by the way, during this September and October, for the negotiation of the post-2015 framework are taking place in Geneva, where the private sector is invited to participate. That is one. Secondly, I think a good example of this collaboration is also with this Africa risk capacity that Richard mentioned, in which it was also linked to the Africa Strategy and Program of Action for Disaster Reduction, and opens also the doors for the African Union Commission, where member states could participate. That will be extremely useful also to highlight these linkages, because it's that where, I mean, this collaboration is extremely useful. Now, let me just convey three messages. One, it is regarding the Sendai conference. As you know, that it has three segments. One, it is the intergovernmental one to negotiate the post-2015. But there is a second segment on multi-stakeholders, in which the idea is to member states to celebrate the implementation of the HFA 1. And that is what the colleague from Turkey was mentioned. So member states are invited to participate in those segments and to inform case studies, how this is being implemented, the case of Senegal, the case of Turkey, and maybe others. There is a third segment, which is the public forum, and applications are open for anyone, any partner, in order to apply and also to consider different other discussions for the post-2015 framework. And number three, there is the issue of in addition to the post-2015 that will be discussed in Sendai, another key aspect, it is to get commitments from partners to support the implementation, as you may know. So it will be extremely important that the private sector, now for example, insurance and reinsurance, get with one combined commitment, and to see how all these instruments that we are discussing here can afterwards will be useful in order to implement the post-2015 framework and to launch this idea during this preparatory process and at the end, of course, in the Sendai. So that I wanted just to share with you, and I'm here to discuss more. Thank you.
Thank you very much. Anybody like to respond to any of those points? Heinz, thank you.
Well, if I may, I'm not sure if I have understood all the aspects of the comments, but I think public-private partnership and cooperation is a very focal thing. And I already made a few comments. Let me give you two typical examples how this cooperation can work. At the onset of our project, we were very keen and willing to penetrate these insurance markets, only to find out that in Serbia there was a law requesting reinsurance to be placed in the country, locally. And we were a Swiss reinsurance company. So we discussed this with the Serbian government, and they kindly changed the law. And they said, only for catastrophe reinsurance may insurance companies seek international cover. Without that law change, our project would have crashed in Serbia. A second example, which is a bit, forgive me, a bit a stupid one, a bit a silly one, but it's really telling. When we hired consultants to do the jobs for us, like risk assessment, modeling, IT work, whatever, we had to write contracts according to the World Bank model. And a contract, each contract has an initial date. So it happened that this consultant had to visit us for a first interview, and he spent money on the trip before the contract was signed. The World Bank rules do not allow to charge the budget with any expenses before the attachment date of the contract. Something that is really a no-burner in the private industry. So we had to use private funds to reimburse travel expenses that occurred before the signing of the contract to keep the situation under control. I don't know what the public solution would have been to this terrible problem. So I can only repeat, you have to get to know each other. You have to learn from each other. It's like a marriage you have to work on a partnership to let it grow and to let it grow in quality. So I think this is also one of the assets we have created, the common understanding between the insurance sector and the governments. And I think for the future we should dwell on that and use this cooperation for other projects.
Thank you. Richard? Okay.
Yes, and in response to sort of Pedro's points about, especially relating to Sendai and what can come out of it that really would facilitate public-private cooperation in the disaster field. This business of having a rating system that would allow companies to enter the market with less cost than they have now, because I mean, are you really going to put in the kind of research that would allow you to understand what kind of financing would make sense in the country, whether that country is safe in the sense of can they use the funds that you would be paying out to them in a way that would create issues for you later? Are they actually in a position, and do they have the political will, evident in some form, to continue to pay for the establishment of these reserves, which is essentially what the insurance function is a part of. Having that, standards for that are internationally agreed. And you can do it with bandwidth of various levels of GDP or whatnot, because it'll be different at various stages, would then allow the private ratings companies like the S&Ps and others that have engaged with us on this effort, and whose entire business model is based on their reputation for providing objective assessments of national financial capacities, a bit tarnished in the recent financial crisis, precisely because of the absence of internationally agreed standards for what they should actually be rating against. So if out of Sendai there can be standards, there can be a process towards standards, or any movement in that direction, I think that would be a great vehicle that allowed the private sector to enter the risk markets and also more effectively create the demand on the countryside, on the part of the participating countries, because they would have a rating, something they know to work against. Look, we set 30 million maximum payout for our countries, not because that bears any particularly profound relationship to their budgetary requirements, but that is what any country in a particular emergency can get from the UN revolving fund, and we had to set some standard of where we're going to start working from. But there must be, and there's work on that other colleagues are doing, some sense of what level of reserve should countries have against risks that we can now quantify. And with that, what combination of different reserve vehicles, including insurance, is the right approach, and then be able to understand how they're being rated against these standards, which creates the demand for better contingency funds and therefore provides better protection for the populations affected. There's a real opportunity here of moving this forward in a quasi-regulatory way, if you will, by setting international standards and then having private sector entities regulate assess and rate the participants.
Richard, thank you. I'll just respond briefly on the commitment side. I think the 23rd of September UN meeting will be a landmark there. So as I understand it, commitments are being requested in the investment side, investments towards resilience, and also resilience actions. The insurance industry is certainly alive and talking about this very strongly at the moment into how they can respond. The Geneva Association, which is a collection of very large insurance companies, are addressing the issue as well. I have no familiarity, and of course if I did, I couldn't take any subject matter today on what may be said on the 23rd, but I think it's certainly central to the radar. So we should watch that space with great interest. Another question, gentleman here on the left.
My name is Haresh Shah. I'm from Stanford University and a founder of RMS. Few comments. I found it very fascinating about ARC. This is very, very interesting. effort, and I hope it succeeds beyond all imagination. I also enjoyed the presentation about Southeast Europe, which is very innovative and good idea. I have a couple of comments. In public-private partnership, we talked about mainly Africa and to some extent Europe, Southeast Europe. If you are in Asia, involvement of the government is not an option, it's mandatory. You cannot take first step beyond whatever you want to do, no matter what innovations you have, unless government is your partner. And it is becoming more and more so than even 10 years ago. A comment about the Turkey project. You mentioned about the California Earthquake Authority. I also want to tell you the current status. I think it's important for us to know that using a model of California Earthquake Authority was good. I was involved after the Loma Prieta earthquake. It was created, CAE was created around 1991, something like that. First of all, the product was to protect the industry and not consumers. It turns out that the product we have currently is pretty bad. Just to give you an example of how a product is voted by the public, in 1991, after the Loma Prieta earthquake, the penetration for homeowners was about 37%, plus or minus one. I've forgotten the number, but around 37%. As of today, the penetration has gone down to around 10%. Why? Because it is such a ridiculously twisted product that community and the consumers who are educated will see it right through. And continuously it's decreasing. The government and, of course, the insurers like it because they would rather not do earthquake business in California. That's why CAE was created, actually, because they want to move out. So there are some very complex issues. And referring to an example at a time when it was needed and how the society voted for it is quite important. And today, I still have home insurance, not because I believe in the product, but because I had to set an example to some people that I know. So, but if I were a consumer, it's a terrible product. So anyway, that's what I wanted to mention. Thank you.
Thank you very much for your comment. There was not a direct question there, if anybody wants to respond. Okay. There's a gentleman in the, excuse me, there's a gentleman here in the second row. Third one along. Thank you. He was very patient. Thank you for your comments.
Okay, thank you. I was rather disappointed when I came here and saw so few people from Africa. But all this has changed. We've got real gems today. I'm very happy. Now, there are a number of things that really count and make me happy. Number one, I'd like to take the point of climate change. And I know that Mr. WILCOX said was a bit dubious about that. There is no place in Africa, no place in the world which has not experienced climate variation. And by introducing this term climate change, we are changing the whole perspective of what you can do and what you cannot do. Right throughout the 40s, the South African government did a lot of work on drought and maize production, etc. And this is true of the United States, etc. Suddenly today, we're being told, well, this is something very new. We require somebody from America to help you to solve your problems. And this, I'm afraid, is going to be one of the biggest problems in Africa. The solutions are going to be local. They cannot be generalized. No way. So that's my first point, that maybe we should get out of this terminology of climate change and call it climate variation, because you end up by many African governments blaming people for climate change. I don't see Obama doing that for the United States, even with the biggest storms. There is very little that you can do directly about climate. So that's my first thing. Point number two is that we've got to understand not only the systems, but the people. It's in here that a bureaucrat may not realize the significance of local knowledge or how the community actually begins to cope. So what can the governments do? What can the private sector do to help communities to cope? Do they have their own mechanisms? And we have some fantastic efforts that we can utilize. May I give one of these? Very few African countries, perhaps less than 1% of the population, are involved with insurance. 20 years ago, less than 1% of the population of Africa had telephones. Look at what the mobile has done. Because you can speak in your own language, you can see what you really see, it brings a level of reality. And so I would urge that the insurance company begins to take that model to see how it get on with work. My third aspect is as follows. We've got to learn to think outside the box. I'm afraid too many of the African countries are committing mistakes by thinking within the box. And it's in here that I was pleased that the minister himself was raising the whole issue that the government itself raised funds locally to bring about agricultural change. The government of Senegal or no African government can change the climate, but it can do something about its agriculture. Okay? So that's a good example. There are good things happening. And then the third thing is how can we make institutions think outside the box? And here, once again, we are missing a golden opportunity. There are too many institutions external to Africa who are working, and the local institutions are completely hard up. Please use your universities to be engaged in research work which is of relevance to the country. With that, I'll stop there, and maybe I take up an opportunity again to make some more comments. Thank you.
Thank you, sir. Just for myself, I may have missed it, but who are you with? Thank you.
I'm Adolfo Mascarenas from Tanzania. I used to be at the University of Dar es Salaam. And one of the things I did was to say that I'm going to pay attention to what the government does, and so that started the whole linkage of research being relevant to the country. Thank you.
Thank you. I'll ask the panelists to react to your points, and then we will just keep an eye on the clock. So if other questions can be a little bit more succinct and direct questions, please, that'd be terrific. But panel members? Heinz?
Well, so far I have heard more comments than questions, but very useful comments. We would like to thank you very much. But this, what has been said by the previous speakers, triggers for me the wish to share some more information with you about Europa. One is Asia has been mentioned. They have similar problems, but they are not so much in focus now. But I just would like to tell you that Europa has plans for later on to move east, if I may call like that. We want to apply the same or similar business models to other countries. But before we do that, we should get this project off the ground. And once we have the proof, we will apply it to other countries, and Asia is also in our focus. The second comment I would like to make is about mandatory covers as against leaving that to the discretion of the citizens. In Albania, there are talks about making the covers we want to have sold by the insurance market to make it mandatory also. This is the political dimension, and we cannot contribute to the discussion. We are party, and we must leave it to the political forces in the country whether or not they want to move that way. And a final comment, I mean, houses can be destroyed, but what appears to me in Africa, in Asia, in other places of this world, agricultural insurance is the most important, I think, because if typhoons destroy the harvest and the people are suffering from hunger, this is the worst, I think, that can happen. So I will also see to it inside Europa that the agricultural insurance we have created a model for that should be sustainable also, that this has a very, very high priority. Thank you.
Thank you.
Je vous remercie, M. Parker. Moi, je remercie ceux qui ont fait des interventions, qui ont fait quelques commentaires et des prises de position. En particulier, je voudrais rebondir par rapport à l'intervention du professeur de Tanzanie qui suggère une solution locale. Alors, jusqu'ici, le Sénégal avait adopté un schéma local de réponse, disons, à tous ces risques par, disons, une contribution budgétaire, un effort budgétaire. Mais la démarche novatrice avec l'ARC permet un peu, ou peut-être permettra demain au gouvernement du Sénégal de souffler, un peu d'épargner son budget pour ne pas, disons, procéder à une augmentation d'impôts pour couvrir les besoins, ou peut-être de délaisser des projets d'investissement, surtout dans la prise en charge des coûts sociaux de l'homme. Je rappelle, l'économiste Schumpeter disait que le développement, c'est rien d'autre que réunir les conditions pour prendre en charge de façon optimale les coûts sociaux de l'homme, à savoir peut-être l'éducation, la santé. Oui, il faut une solution locale tant qu'on a tous les instruments, tous les moyens, et surtout d'avoir une attitude, avoir des instruments ex ante qui pourraient permettre demain de ne pas trop solliciter le budget. Donc c'est par rapport à la prise de position du professeur de Tanzanie que je disais oui, une solution locale si ça permet d'avoir tous les instruments ex ante et d'avoir les moyens de faire face. Aujourd'hui, l'ARC a permis de mettre en place un instrument novateur qui un peu soulage les gouvernants en matière d'approche budgétaire. Voilà ce que je voudrais dire.
Thank you, Minister. I think we have time for one more question, probably. Do we have any? Sorry, maybe two questions. A gentleman there and a gentleman over there. So if you could keep your questions nice and tightly framed for us, please. Thank you.
Thank you. My name is JC Amado, and I'm a manager at Deloitte on climate change. Most of my work focuses on climate change resilience and climate disaster risk reduction. I have two specific questions for Richard WILCOX. I'm wondering, so you've presented your adaptation payout based on the Extreme Climate Index, and I'm wondering how you plan on not just basing payouts on exposure to set climate-related thresholds being exceeded, but also taking into account the different levels of vulnerability of countries, meaning, you know, the probability distribution functions of loss and damage across, for example, drought intensity will vary across countries depending on the crops that they have, the quality of the irrigation infrastructure. So I'm wondering if you're thinking of that as well and how you'll take that into account. The second question is around moral hazard. I'm wondering how you plan on monitoring and evaluating the progress made by countries in reducing their vulnerability to climate change. In other words, how will you tackle the issue of climate change adaptation evaluation? As you're aware, this is a very tricky field. A lot of research is being done on it, and no real solution has really come out of it.
As the immediate target, should I answer, I suppose. The way we conceive of the payouts is we would have a fixed amount per country, per region, related to the country's own engagement in managing their weather risk under the current climatology. So the payout would not relate to any actual losses suffered as a result of the extreme events that are captured in the Extreme Climate Index, but would be an amount fixed for projects that have been developed by the country with a view to a potential payout at the 5-year mark that the country has identified and that has been peer-reviewed at the continental level as the most cost-effective type of adaptation projects. That is this Pillar 1 exercise that I briefly highlighted, which is led by our colleagues out of the University of Cape Town as that are doing the lead research on this effort, and that's an entire cottage industry on its own. Now, the issue of moral hazard also goes back to the issue of climate variation, climate change, or what do we call this? For our system to work, for me, the attribution part of it, whether this is attributed to the extreme event, changes in extreme events, is a climate variation that would have occurred even in the absence of an increase of temperatures driven by emissions, or not, is not the key focus of our exercise. We want to provide that additional protection, whether it can be attributed or not. And certainly the African countries, our members rightly take the view, listen, we've contributed at least to emissions and then rising temperatures. So if there is an attribution, then certainly we should not be the ones who have to pay for this out of our own resources, but this is something where those who have benefited from the economies driven by these emissions should pay. And as you know, that's sort of the basis of the international loss and damage negotiations. Where that will go, frankly, I have no idea, and I don't think anybody really knows whether this has legs, has been doubted by our colleagues. But to be clear, the reason we put this together in the context of climate change is because that is where the political debate is, and that is where funding allocations for that would benefit our member states are being made. And what we are trying to design is a vehicle that would allow our member states to effectively access and use whatever funds are available in that business, whether it's the funds, the allocation of those funds is related to attribution or not, whether it's a variation or climate change or none of the above that is seen as responsible for this exercise.
Richard, thank you. We've actually got a queue of questions. There's a gentleman here, and then I think we'll have to wrap it up with one more question over here. Thank you.
Thank you very much. David Myers, Public Safety Canada. We're the Federal Government Emergency Management Coordinating Department. But my question is more along the lines of my interest in the financial aspects, the financial resilience here. And it seems to me that this program is going to be quite a strong contributor to overall financial resilience of these countries. And I wonder whether overall there's been a reflection of this potential change in the rating agencies' views on the debt and on the overall investment attractiveness in these countries. So that's essentially what I was interested in, to see whether there is a recognition by Fitch or, say, the OPIC, the insurance agencies that promote or protect investment, and whether there's any coordinated response, perhaps with, I know the IFC, for instance, is interested in stabilizing and promoting development of local capital markets. It seems to me that this might be an opportunity for connecting those two efforts. Thank you.
Thank you very much. I'd be happy to take the rating agency question if anybody wants to take it. Yep.
Just very briefly, I mean, yes, as you may have seen, there was this recent work by S&P that tries to sort of include climate considerations in countries' basic financial liability that would go into their ratings. I mean, that's still very early work. But to be clear, what we're trying to do is something more specific than addressing the overall financial viability of the country relating to its debt, which is what the companies are interested in providing. It is the country's viability of managing its disaster finance. And really only for the first time in the last couple of years, and certainly in the African context with Africa Risk View, our own software package, have we reached a level where we can quantify countries' risk exposures in terms of their budgetary cost of a disaster, which is different from the loss, related to but different from the actual loss suffered by individuals or even the community. We finance government budgets, assistance to populations, and in that context, a government's ability to effectively finance disaster assistance contributes to its political stability and also to its budgetary stability, which is then related to its ability and its ability to fund other activities such as repaying debt, for example, which is of course what the ratings agencies are interested in. So there's an emergent relationship, and we are in discussion with the ratings agencies of how that might be reflected. But our focus is very much on the standards for a regulatory regime that would set standards internationally that ratings agencies could then rate against, which was the big criticism of the sovereign debt ratings, is essentially they kind of all make it up on their own and decide what to rate against. There's no international set standard. So through the engagement at Sendai and elsewhere, we hope to push this forward. But it's an emergent line of work.
Just so for the rating agency, I can speak from Martyn's experience and knowledge. I can't speak from the rating agency perspective, but I think in many areas we're seeing much more interest paid now to disaster risk financing and the liabilities held by the various parties here. And it's certainly true, at least two of the rating agencies are talking to our company more and more about how this can be considered and managed. And Standard & Poor's, I think, have produced two publications on the disaster risk financing and how it may play into rating assessment at a later stage. It's obviously a very complex field, and what you don't want to do necessarily is create a problem for countries which are emerging and developing very rapidly by giving them a negative perspective because of these issues. So I think there's a sensitivity around this, but there will be a recognition over time. Certainly aware yesterday there was a session here on encoding those liabilities, contingent liabilities in the financial systems. So I think there's a groundswell of opinion coming. It's probably not this year, next year, or the year after, but I think it will play in over time. If you take a helicopter view of this whole discussion around the globe, all of the different agencies that are interested, all the different financial services businesses and associated businesses, development agencies, we've got some fantastic work going on. But there's no one conductor to have them play beautiful music. They're all playing their own music in a little way at the moment, so we need to work hard to get that collaboration together. And then one final question, I think.
Thank you. It's not really a question, it's more of a comment. I'm Eka Swahia, and I'm also with the African Risk Capacity. And I also wanted to just mention that a lot of the work that was put into developing the ARC and the innovation as we see it actually also came from understanding our specific country context. For example, the context or the situation that Senegal faces and its ability to actually structure a policy that meets what it requires. So when we talk about the ratings agency, that also came from understanding our countries and trying to create, again, an innovation, but something that works for them and that other entities such as the private sector, as Richard mentioned, can look and use as a guide for investment in resilience. So we are really open to working with partners such as the UNISDR and others who are interested in working in this space to really try to create something that works, something that is tailored to the needs of a lot of the developing countries that we work with on the continent and also outside, but can really address this question in a different way. So I just wanted to make the point that a lot of these solutions and innovation that we've seen has also come from understanding our countries and the nuances and complexities that they face, and we're open to working with partners.
It's a little rude of me to be a chairman here in Switzerland and run over time. Switzerland is very famous for being on time, so I will just make a couple of closing remarks before we hand back to our host Walter. So I think we've established financial preparedness is essential in making funding available quickly for disaster response and reconstruction to make sure individuals, businesses and governments get the resources necessary as quickly as necessary to limit the consequences of these disasters from an economic point of view. Closing the protection gap between economic and insured losses is a duty for the insurance industry. We need help along the way, but pre-event risk transfer tools as part of the toolbox make enormous sense. It's a cost-effective way in insurance to deal with low-frequency but high-cost events. The benefit of insurance mechanisms for disaster financing goes along beyond the pure funding aspect. By having an insurance price, you have an idea of the risk that's run, and that price, of course, will be cheaper if more resilience and mitigation measures are taken. So, in fact, resilience and mitigation go hand in glove and are very complementary to the insurance side of things. The more mitigation and resilience we build, the cheaper the insurance premiums will be. They're mutually reinforcing. In terms of the post-2015 framework for disaster risk reduction, I certainly believe it's utmost priority to recognise financial resilience as a critical component of effective disaster management and the role different insurance instruments can play. The current framework lacks in this respect. There are huge gaps in financial insurance education and training for disaster management specialists, and equally on disaster awareness and exposures among public finance specialists. In short, we need a more joined-up effort between finance and disaster management disciplines, and we hope today's panel session and the great contributions from our panellists have given you food for thought in ways in which we can practically do that. So with that, Walter, I will close the plenary session, but I think you want to just say a few words.
I want to be very brief, but just to express my very warm thanks to a fantastic panel, to express my warm thanks to the chair, to the keynote lecturer, and to all the panelists, and of course also to you, dear participants. And last but not least, once again, I would like to mention that Swiss Re is our platinum sponsor, and the session has been co-hosted and chaired by Swiss Re. Thank you very much, and as usual, we would like to provide a small gift which consists in providing a certificate which demonstrates that we support the retrofitting of a house in Bangladesh. And with this, I think I would like to invite you to give a warm applause to the chair, to the keynote speaker, and to the panelists. Thank you very much. Thank you for a wonderful panel.